Hey, Steve Zonard here with Treviso Realty. Happy Monday morning. Just a real quick update on the market. Current inventory, we're at 27,520 units, so not much gained over the last 7 days, which is good news for us. Just 100 units since the last week inventory count. The big change is the amount of homes that actually sold. So last week we had 300 and change sales in 7 days on the closings rather. And then this week here we have 682 sales. So that's double the sales that we've experienced the week prior. And we are noticing this. Obviously, there's a big influx with the snowbirds. March should be our busiest month. But we're also looking at new builds too, because we do a lot of the new construction sales and obviously resale. But even the new construction, we always take note on different communities. And one in specifically is Verdana. Obviously, we live there, so I have a good pulse, finger on the pulse for that market. And you're starting to notice like properties are selling there quite fast. Obviously, we're still dealing with a lot of the price adjustments. We don't know where in pricing is in Verdana Village currently right now. Because if you're building a dirt lot, you're going to be at one price, and if you're buying a quick move-in, it's very attractive, clearly, because they're slashing prices because they don't want to own inventory. They're like almost a bank. They don't want to have inventory on site because that costs money going forward, so they want to basically cash out. So this is where our best deals are going forward. I have a new list here from Verdana Village for Polte specifically, and just for example, like you can get into a Mystique, which is one of my favorite models. It's an executive model. Zero corner doors, the whole thing, and you can get into one of those properties for like $556, $80,000 savings, and then ultimately I'm sure there's a little bit of room for negotiation. So let's just say $530, $540 on a Mystique, which is amazing. That's a great deal. And then if we kind of move it across the parking lot into Lennar, we had a client out from Illinois, and we were showing him some property, and it was beautiful, like Marsalas and Trevi's on a beautiful preserve. I think some of the better lots in phase 2, and as low as 480 to 500,000. I mean, the Marsala is gonna be a little more pricier, but I mean, if it's a quick move and these guys are ready to negotiate, so let's say 480 to 500,000, which is definitely great value considering where these prices were in the past. Like I think the Marsalas were probably 6.5 and change at the height of the market, so they've dropped down around 20%, and that's just like market in general, not just here in Florida. That's also I have another real estate office that I manage up in Toronto, and that's a very fast market. If I kind of give you a pace, I think in Southwest Florida we're over 1 million and change in people, and that's 10 million. 10 million people in the financial capital of Canada. So basically it's a fast moving city. I mean, bidding wars, an average sales price for a home there is $1 million. First time buyers for a townhouse is $1 million, $1.2 million. So just to kind of give you some an idea of what the values are down there, and that market is dropped around 30% since the top of the market. So we're still decently good here, thinking that we're going to drop around 20%, and that's obviously the new builds because they're really slashing prices, just trying to get their inventory off the books, which is great. And another client come in last week also. We went through the whole range. I have a whole specific schedule I show clients to kind of show value from Naples to Estero, Bonita between sometimes, depending if they like that section, into South Fort Myers, into North Fort Myers, to kind of show you the values, because the builders are the same. That's Lennar, Polte, DR Horton, and some of these smaller builders, but let's say the big three, and you can kind of show you the value from like Naples going north and kind of see the same exact house with lesser or better amenities and more your money going, because how far your money goes. Because if you get into like let's say a Venice in Verdana Village for 500,000, I can get that same house in a nice community for 300 and change, like 315, 320. Kind of show you that's like almost a $250,000 spread between both units. It depending where you need the property. If you need to specifically be south, or you're just a secondary property and you just want to have a house. But anyway, I have a whole process, and we're going through all the builders, and they are holding less inventory than normal. They're only releasing maybe 5 to 10 properties at a time for sale, which is good. Obviously keeps the numbers down, so they'll sell what they have and then replenish the list, which is obviously good. For resale, is obviously it's kind of everyone's towing at the same pace right now, and what we're doing with functioning right now is basically all price related. We need to do price adjustmts every 7 to 14 days, and that's just normal in a market where we're not sure where the price is. And then there's a ton of buyers, pent up demand for buying. It's just you got to meet this buyer at some point in pricing. And then what we're looking at also is just the market as a whole. So this is the 10-year treasury, like the treasury bond here, and so basically what happens here is whatever this rate is, they're usually going to tack on, depending on also the strength of the market and also inflation, like the CPI rates, usually 1.5% to 2%. So we're at 4.2% right now on the government bond, the 10-year bond. And if you look at this is going to get a little boring, sorry folks, but a 30 fixed year mortgage, it basically relates to that. They put a 2.5% top up on this portion here, so it gets us that amount. So in order to get these rates back down to 5%, because currently if you see that's a 7.76, we need to get this rate down to around 2.5% to 3%. And what needs to happen is obviously if this starts getting sold off, a lot of the bonds, which kind of weakens this and gives us a better opportunity for a rate. And I mean the CPI also, we'll take a look at this. I mean, look at the balance. The Treasury or the Feds want to get it under 2%, but it's really never under 2%. It's 2.5%. It kind of fluctuates between 2.5% and 3%. Clearly, once we get it, look at that. So even in 2018, we're at 3%, currently at the same rate as today, so the CPI. And it drops off in 19, going into a really nice market. And this is obviously the Trump administration gets into power, going to a nice, take down inflation. And then, this starts happening, right? This craziness with the pandemic. Clearly, we go up to 6.8% inflation, and now we're descending down into normality. And if you kind of look now, we're still kind of status quo at the 3%. So this would need to come down, obviously, another half a point or 1% total to kind of make anything, make some waves in the market that'll benefit us as the end user. But I mean, energy costs, we have to look at that too. So if I get into crude oil somewhere here, just take a look at this. I mean, so 5 years, we go into April of 2020. Obviously that's a way different time. Let's just go, that's going into COVID times. Let's go into just regular season here. So 2014, 2015, we're at, $40, $50 a barrel. 17 is a little bit of a spike in everything in the markets, both sides of the border, $70 a barrel. And then we're kind of hovering between this 50 and 60. We then obviously COVID happens, everything shuts down, no one's buying oil because the whole world economy drops down. So it goes $19 a barrel, and then we get this insanity up to $105, $115 a barrel, and now we're kind of dropping down. If you look at the last month, especially with the new administration now, you're starting to see this kind of come down, and they're starting to bring. Obviously, they're drilling and doing a bunch of stuff right now. They're putting maximizing energy, which is good. We're starting to see ships come in that have been parked in Africa for literally 8 years, or 4 years rather, and then ultimately, these are big oil ships that carry 1.8 million. Liters of oil, so they're all coming back into the shoreline, especially in the Gulf, more than likely into Texas, and start getting these things producing and selling oil. So what that does is gives us a better opportunity with inflation, because if the lower this dollar of the barrel amount goes down, obviously that's going to be efficient for us with the end user, because all the costs start going down associated with that. So like little things like this, I mean, there's small things that we're following, but that's pretty much it.